Hey everyone, welcome back to another episode of AWM Insights. I'm your host, as always, Justin Dyer, Chief Investment Officer here at AWM Capital. Also joined as well, as always, by Mena, Hanna, Portfolio Manager here at AWM Capital. We're recording today's conversation earlier in the week than we normally do. Some scheduling conflicts drove that, but also, I guess, let's say timing got lucky here, to use the investment analogy, where the big news on Trump's tariffs came out and the Supreme Court ruling them null and void came out on Friday. Markets today, Monday, are reacting pretty significantly. The simple punchline here is, hey, markets now have a huge dose of uncertainty injected into them, and markets just don't like uncertainty. And so today we're going to walk through what's going on. Number one, just try to understand it all. There's a lot of moving parts here, moving pieces. But then also, hey, how do we think about this from an individual investor perspective? So, Mena, let's jump right into it. Can you give us as much as we know, right, an overview of what's going on here?
Yeah, there's a lot here, and I really did think we left tariffs in 2025, but here is kind of the 30-second pitch. So on Friday, the Supreme Court determined that many, if not all, of Trump's tariffs were not legally admissible, and that the $200 billion of tariff revenue was not collected properly. So we kind of went back to square one from a tariff standpoint. Trump responded with a 10% blanket tariff on Friday, which then grew to a 15% blanket tariff. There's also the corporate side, which I think is super interesting. A lot of these corporations that have had to pay tariffs for the past year are now going back to the U.S. government and trying to collect
their money back.
Trying to collect a piece of it. So extremely complicated process. We also don't know a lot of this. We don't know what's going to happen with previously agreed upon trade agreements. We don't know what's going to happen with a whole slew of things. But what we do know is markets don't like uncertainty, and we are definitely getting a lot of that right now.
Yeah, and you combine that uncertainty with the jitters we had probably over the last month or so around AI impact, AI overinvestment, AI bubble, and we're combining all these forces today, right? This is my I guess just a limited understanding of this, and like you said, markets don't like uncertainty, and so when there's uncertainty, general reaction is to sell. Now, not from our standpoint, right? That's not the strategy that we employ. We're very long-term. We don't think you can time these things, and using at least the last 12 months in tariffs specifically. If you've used that playbook, sell when there's some sort of uncertainty around tariff policy that's been increased, right? Liberation Day being kind of the most infamous one. That's been a losing strategy. But in general, markets react, right? This is what we're compensated over the long term for, to deal with situations like this. Now, the approach that we take, right, is let's have a plan ahead of time to deal with periods of uncertainty. This is a new period of uncertainty, different set of circumstances, but markets have these all the time, right? That set of circumstances is different, but it rhymes time and time again, and we need to have a playbook. So from an individual investor perspective, let's walk through kind of just like high level playbook, right? We can even start with the season. Major League Baseball season's right around the corner, right? So paychecks are going to start to hit. Maybe signing bonuses already did hit for people that are in that lucky category. How do we go about managing those situations?
Yeah, and really it's deja vu kind of from last year. If you got a signing bonus kind of around this time last year and you were thoughtful with it, you probably did extremely well. I'll also kind of take an extension of this. Two of our clients were just in the top 10 at the Genesis Invitational. Like, they obviously made a good chunk of money. That's actually very beneficial to get capital inflows into your account when markets are selling off, because you can deploy them and kind of buy equities, especially when they're on sale in a way. So it's beneficial in general. Now, you don't want to just dump all your money into the equity market right away. You kind of have to take a more holistic picture and figure out what your needs are for the short term. And this is why it's so important working with your advisor, figuring out what your priorities are, and then allocating your capital towards your priorities in an efficient and effective way. But it is actually a good thing, I would say, to get some money, get your paychecks, get your signing bonus, get your bonus from a tournament during periods like this, because you are buying things on sale when the rest of the world is selling. And this is really when you can differentiate yourself from the rest of the market, from the dentists and doctors out there that are selling in their 401ks and scared because of, potentially what they saw 11 months ago. If you take the opposite stance and actually invest like a thoughtful long-term investor, these are actually periods where you can maybe make an extra % or two over the year because you're deploying when the rest of the market is not deploying.
That's right. It takes discipline. It takes having a plan ahead of time. And we know, right, really as long-term investors, generally, whether you're investing today or 3-4 days ago when the market was slightly higher, you're still going to come out okay. But to your point, this is actually an opportune time, and you didn't even control it, right? You're just following your disciplined path, and we always like to say, control what you can control, follow the plan, stay disciplined, and you should be set up for success way down the road, right? That's true in any market environment, but it's really, really important to remind yourself that in this current market environment where volatility is heightened. And also, I think it's also a good reminder, we don't have to go into great detail on this, but diversification also matters here, right? The bifurcation in market performance year to date has been pretty substantial. U.S. underperforming quite a bit. And most listeners should know that we're very much believers in global diversification, and that's benefited our portfolios quite a lot so far this year. But also know that you're not just investing all of that cash into the U.S. stock market. You're working with your advisor, figuring out priorities and allocating in a very thoughtful way. So that's super helpful. That's talking through, cash to deploy, right? It often feels really, really difficult, I think is the right word, to put new money into the market. There's always some sort of activity or event or whatnot, or cause for concern, and that's normal. There's a great old adage I love saying, the markets crawl or climb a wall of worry, and each and every day that worry could be different. This is a little bit of a heightened worry, and we can understand that, but it's also very much a good time to invest for the long term. So that's the either new investor / investor that has cash coming in. What about how do we just manage through this for existing investors, existing portfolios?
Yeah, for existing investors, you ideally have a plan that's in place that can weather through these storms. We don't know if this is going to be kind of a one-day event. We don't know if this is going to last for a week or potentially, kind of backtracking to Liberation Day 2025. It was a couple weeks of pretty serious volatility. So we don't know how long this event is going to last for, but you need to always be prepared to weather these storms, whether they're a month like, Liberation Day, whether they're a full year like 2022 with the spike in inflation and the invasion of Ukraine and a lot of different things. You just need to have a plan in place to weather the storm. And if you are kind of building your boat or preparing your house for the storm when it's happening, it's already too late. So it's really important to have a plan in place and not kind of do all of this when things are getting crazy, because you're already too late and the damage is probably done at that point.
Yeah, exactly. Right. And I think that's you're spot on. I would just add to that point that the house is built custom to you, right? Yeah. The boat is built custom to you and your priorities. Your priorities are protected in an incredibly thoughtful, high confidence manner. And the part of your portfolio that maybe is fluctuating during times like this is built to do that, right? We allocate there because we want long-term growth, in order to get long-term growth, we have to go through periods of time like this. Those two things are interchangeable. You have to take on risk to get the higher return that equity markets, stock markets actually provide you over the long term. So I've said this, I think, a couple times over the last couple months, that periods of time like this are healthy. The reason and rationale behind why markets are correcting or becoming volatile, again, changes each and every time. Maybe that is healthy, maybe that isn't healthy, the catalyst, so to speak. But markets having risk, not just going up and to the right in a flat line, is healthy, actually. And that's also a really great reminder. If you have that custom house, that custom portfolio built to support your unique needs, that's exactly what we do. Your priorities are protected, you are protected, then you're actually better off in the long term by taking risk where risk is appropriately taken, so to speak.
Definitely. And two things that I'll also add. One thing that I really want to hit on is the market might look completely red today in the US, but it's not completely red internationally. We were talking about it before this call. China, Hong Kong, those markets are up 2.5%. That's a big day. And our markets are down, 1.5% roughly across all three major indices. So that's a pretty big swing in delta in performance. That's why you also take the diversified approach, and you don't just bet on one horse. You ideally win no matter what. You win when domestic markets are doing well. When domestic markets are not doing well, you also have another horse that could ideally win you the race. So that's something that, if you're thoughtful on how you actually build your portfolio, you can potentially have positive performance even when domestic markets are negative in general or potentially flat.
Yeah. Great reminder.
Yeah. The other piece too, and we kind of liken volatility to a storm. Typically after the storm, you get some nice weather, you get a rainbow after. If you actually look at it, and this is kind of tied to some just hard evidence and hard data, when the VIX is up, that is typically when people are leaving the markets, and that's the worst time to actually leave.
VIX being a measure of volatility, movement in the markets, yeah.
That is the volatility index. And from that point on, typically returns are higher because markets recover, and then markets ideally stabilize and come back to, there's an element of mean reversion there. So I kind of liken markets to maybe batting in Denver. After this happens, like your batting average is probably significantly higher because there's a return to the mean, and you actually get even more favorable just dynamics in general. So while everyone's running away from batting in Denver, you should be, excited to bat in Denver because your expected returns and your probabilities of success are typically higher, especially over the long term.
Yeah, during periods like this. Yeah. Cool. Well, a lot going on. So trying to summarize this, right? Markets don't like uncertainty. We just got a whole bunch of additional uncertainty injected into the market. But our approach to investing is prepared for situations like this. You and your portfolio are built for your unique needs and circumstances. You're protected, and periods like this actually are good for your long-term outcomes, right? We need periods like this, not necessarily again for the psychological feel, right? It doesn't feel great to go through times of volatility. It definitely doesn't. But if we take a step back, focus on what we can control, stay disciplined, ask questions for sure, but stick to that plan because we know it works over long periods of time, right? We are going to be better off for the long term. So that's kind of the quick summary here. Hopefully this was helpful. A lot going on. If there are any specific questions anyone has, shoot us a text.
Yeah, 626-862-0355.
Cool. And we'll wrap there. Until next time, own your wealth, make an impact, and always be a pro. Thanks for listening.